Can I use a universal life product for infinite banking? We're going to dig into that right now. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me, as always, is Christina Wyatt. Hello, Christina. How are you?
Hey, Darren. I am doing great. How are you doing today?
I'm doing fantastic. Excited about this podcast. We've had a lot of requests about this, and a lot of times when we're meeting with new clients, they're like, "Oh, I already have a policy. I have this. Can I use it for this?" And we always review current policies to see if there's something we can use. But we're going to dig into universal life versus whole life and infinite banking today. Christina, where do you want to start?
Well, where I always start, Darren.
Oh yeah.
If you're listening on your favorite podcast platform, please make sure that you subscribe and leave that 5-star review. If you're listening or watching on YouTube, make sure you like, subscribe, and hit the bell button so you always know when new content is coming out. And if you're not already, make sure that you're following our social media accounts at Control and Compound on Instagram and TikTok.
Love it. Okay. So I just want to state up front, we're not going to say, well, even if we do say it, we don't really mean it. Universal life is not evil. It's not terrible. Your advisor wasn't like trying to screw you when you sold a universal life product. It's a great planning tool. In certain cases, estate planning, sometimes on the corporate side, Christina, we see universal life really makes sense if it's just death benefit. But we're going to dig in today. What about for infinite banking? More of the where we're interested more in the cash value and accessing cash and getting loans, etc. So we just want to clarify: universal life not a bad product. We just don't think it's a good fit for infinite banking, and we're gonna explain that. So where do you want to jump to first, Christina?
So maybe we just start with the two products that we're comparing, right? So like you said, a lot of people will ask, I've got a universal life policy, can I use it? And then I explain the product that is best fit for infinite banking. And that is the participating whole life policy. So we've talked a lot about it on our podcast. So you guys know that the participating policy is what we need to use. The whole life policy is what we need to use for these infinite banking. And that's because we've got that dividend that's being paid, got those guarantees. We're gonna dig into the differences between the two for sure. We're not gonna spend a ton of time going through the participating whole life because you guys have heard it. So we're not gonna do that. We're gonna talk a little bit about the UL, the universal life, and when we say UL, that's us shortening it. We do that. So universal life policy. So if you want to just give a quick background on the universal life, Darren, and then we can go into some comparisons between the two and show you really why you've got to use the infinite, for the infinite banking policy, that dividend whole life, participating whole life paying policy is going to be the best for you.
Yeah, and just let's go back to the beginning. Really, when universal life first kind of came out in the 1980s. So for those of you that don't remember the 1980s, it was the wild, wild west in the stock market, man. The stock market was booming. It was going up 15, 20% a year. Now, inflation was 15, 18, 12, 15, 18%. Interest rates were that. Mortgages were 22%. So it was all relative. It was like, you're still losing money, but it sounds like you're making lots because the returns were so great. So whole life's been around literally since 1846, been around forever, 100 plus years, most of the companies we deal with. But in the 1980s, the dividends for whole life were, like 12% in that ballpark. But people were investing in the stock market thinking 15, 20% they were getting some years. And of course, they thought they'd get that every year for the rest of time and it would never have a bad year, and et cetera. But what happened is whole life sales kind of started coming down because really the 80s is when the stock market really got accessible to everybody. Before everyone kind of had pensions and didn't invest. So they were investing in the stock market. The baby boomers were investing. And then they said, well, I don't want this whole life. It's only a boring, effective, tax-free 12% dividend. I can get 15 or 20 in the market. So insurance companies came up with this universal life where they kind of said, okay, we're going to have a death benefit, and then we're going to have a separate portion that you can overfund, invest basically in the stock market. Now, you could go in GICs, but it was really designed for the stock market. So that was the idea. And if you bought a policy in the 1980s, I'm sorry. On behalf of the industry, I apologize, because we see illustrations that were literally Well, assuming, where the stock market does 12 to 15% every year for the next 50 years, you're going to have approximately $1 zillion at retirement. And the stock market didn't do 15% a year without ever a bad year. You don't have a zillion, and your policy probably blew up because the projections were just unrealistic. So that's kind of where it came from. But UL is more the whole life criticism sometimes is how do I separate how much is cash versus death benefit? UL does a better job of that in the sense that here's the death benefit. You only have to pay for the death benefit if you want, and if you want to overfund, you can put it in there. So again, in theory, doesn't look so bad, but once you start digging into what the product is, it's not a good fit at all for infinite banking. So want to jump into fees, or do you want to talk about volatility?
Well, so I just want to kind of talk about where we want to go with this. So, with the infinite banking policy, we know that there are certain things that we want to achieve, right? You read Darren's book, Be the Bank. We know that we don't like wealth destroyers. That is what we want to get rid of. That is how we keep our wealth uninterrupted and compounding, right? So, we want to eliminate the taxes, the fees, the volatility, and the spending. We're adamant about that. So, I figured in this podcast, what we can do is kind of break down those individually and talk about what each product does. Do they eliminate? Like, does the universal life eliminate the fees for us? And how does that compare to what the whole life fees look like? The volatility, the taxes. So why don't we start with the fees and kind of work our way through, which is it's really gonna show us why we have to use that whole life at the end of this, right?
Yeah, 100%. Okay, so let's jump into fees. So fees, again, the universal life products of today have gotten better. Some of the companies have gotten better, I should say. So there's Christina and I were looking at one the other day, and the fees on this, they're similar to like a mutual fund or a segregated fund. If you go in the index funds, you might get down to like 1, 2, 3%, sort of in that range. Most of them are going to be 2.5%, 3%, but somewhere in that range. But some of the companies still have huge fees, and almost all of the companies' products 5, 10, 15, 20 years ago had massive fees. So they used to play some games with fees, right? Universal Life, it was the ultimate smoke and mirrors. So you'd buy a Universal Life, and your advisor would say, "Oh, we're just going to assume a 6% return each year on the stock market, and we're going to put it into this mutual fund." Well, what they didn't necessarily explain fully is, well, that mutual fund had a 3% MER because the insurance companies were charging a lot for them. So 3% investment expenses. And then oftentimes there was a 1 or 2% surcharge because it was a universal life plan. So you could be paying 4 and 5% in fees. So when you're projecting 6%, you're really projecting 11% return minus a 5% fee, 6%. But the client just looked at their statement going, oh, 6% is reasonable. Well, no, not with a 5% fee on top of that. And then some of the games they used to play with these bonuses, like guaranteed bonus, performance bonus, all that was basically smoke and mirrors to try to make the illustration look sexier. So a guaranteed bonus might be every year we're going to give you like a 1.1% bonus. Oh, cool. Every year, 1% bonus on top. But if they did that, they increased your hidden fees by 1%. So you were no better off. It just made it easier for the advisor to illustrate, oh, I'll just illustrate at 5% with a guaranteed fee bonus of 1.2 or 1. Well, really, they were illustrating at 6% because the equivalent extra 1% charge in the fee. And then they had some called Performax bonus that if the market did 5%, you got a 2% bonus. And if it didn't, you didn't get the bonus. Well, they'd jack up your fees another 2% for those. So the fees in universal life across the board, higher than whole life significantly. Older policies, just astronomical fees. You compare that 2, 3, 4% fee to whole life, and participating whole life, we're usually around 0.1, 0.14, 0.18, somewhere in that range. So instead of 2%, 3%, or 4%, we're 0.14, 0.12, 0.18. So literally 20, 30 times more in fees than universal life. So for me, that's a full stop right after fees. But did I miss anything on fees, Christina?
Nope, think you got, yeah. So I think you kind of nailed it there. The difference in why we can't use that universal life, number one, is that the fees are higher. We might use it for other reasons. Again, not saying universal life is bad, but we want this wealth that we are holding inside of our policies to continue compounding uninterrupted. We can't have those fees jeopardizing that. So higher fees are obviously going to do that. We want the lower fee product. That's number one. Number two, volatility. So let's chat about volatility. So when we've been talking about these funds that we're investing in, we're talking about funds that are in the stock market. They're market linked funds, right? That is the idea behind the universal life, the reason they made it in the 80s, so that you were able to have your life insurance and invest in the stock market too. So if we're investing in the stock market, what do you think is going to happen with those returns? It's not going to be a smooth ride in the stock market, right? We've seen last year that -20. And for those of you that have a universal life policy right now that's invested, if you go take a look at that statement for last year, you're going to see the -20 just like everybody else that is invested in the stock market, because that's what you're participating in, right? So we've got that volatility and those ups and downs that we see. Also, those funds, they're not guaranteed, right? If we have that dip, we're going backwards. So we've got lots of ups and downs, and we've got market volatility. In our participating whole life policies that we use, we have very low volatility. We don't want that. This is our savings account where we want to hold our savings. We can't have those ups and downs. We measure volatility with standard deviation. And if we look over, a 30-year historical performance of one of these, we know that the dividend, the historical dividend has a standard deviation around 1.5%, right? It's very, very low compared to the stock market. That's around 16% or so over the last 30 years. So tons of ups and downs. The other big thing about our dividends is that once they're paid, they can never be taken back. They cannot go backwards, and they're guaranteed to always go up every year. That's without the dividend that has been paying every single year for the last 150 plus years, right? So the volatility is very low, which is something we need. If we wanted to be in the stock market, we would invest in the stock market, right? And that's not what the idea of the infinite banking strategy is. That's not what we're trying to achieve. So we got to eliminate that volatility. So looking at the two in comparison, your volatility is a lot lower in the whole life policy.
Yeah. And Christina, to borrow your line, when does a deal of a lifetime happen? When someone needs money and someone has access to money. And I want to have access to money when the deal of a lifetime presents itself, and it usually presents itself in volatile times. 2008, all kinds of deal of lifetimes happened in 2008. 2023 might be the same thing. If we get a massive market correction and your UL drops 20, 30, 40%, are you really going to access it at that point to take advantage of an opportunity? Probably not. It's like the stock market. You'll say, well, I'll wait till it comes back. And I'll be sitting there with my whole life that hasn't dropped, that's guaranteed to go up, that increased 2022 and 2023. And I'll say, woohoo, I'll take that deal of a lifetime. Thank you very much. So that volatility is huge, which, speaking of opportunities, that leads into the next one, which is how much can you access whole life versus a universal life from a spending or a borrowing capacity. So if we step back and think of borrowing, so, okay, you buy a house, you buy a piece of property or a rental unit, the bank's going to loan you somewhere between 70 and 80% of the value. Now, why do they use that number, maximum 80%, say? Well, they use that number because housing prices are volatile. They can go up, they can go down, and it's a pain in the butt if they need to come in and foreclose and get a lawyer and a real estate agent. So they're building that buffer in because they're worried about you paying, and they're worried about if they need to foreclose, they want to make sure they get the full outstanding loan back to them. So they'll go 80%. But for a whole life, they go to 90%. Why is that? Because there's no volatility. Guaranteed to go up. Can't go backwards. Once you get a dividend, it's yours to keep for forever. So it can't go backwards. So that's why they go to 90%. Again, it's not that they're nice people. It's just it's financial prudence that, okay, we've got backing for this loan that can't go drop in value, guaranteed to go up. Oh, and we have a death benefit if the person dies. So insurance companies are protected. When we jump into universal life, the most you can typically access on these is 50% of your cash value. Now, why is it 50% for UL instead of 90% for whole life? Well, because the UL is typically invested in the stock market, which is very volatile, like you just talked about in the last section. So the insurance companies are looking at this going, you got 100 grand in there. We're not going to loan you 90 grand or 90% of that, because tomorrow you could have 70 grand in there. And then we have an outstanding loan of 90 and a cash value of 70, because universal life, doesn't matter what your account value is today, it can drop significantly tomorrow and the whole account value drops, versus whole life. Every time we get that dividend, it's ours. That's the new floor set, and we can't go down. So if you just think it logically from a lending perspective, there's a reason why insurance companies don't want to loan more than half on a UL, because of the market volatility. They could lose money. And then, you can go in GICs in whole life, but we typically don't see that, other than on a corporate case where there's an estate need to buy death benefit. But most of the people that are talking about infinite banking are thinking, oh, I'll just invest in the stock market inside of UL and do infinite banking there. But you just can't borrow the money. So the whole idea is accessing money. Well, you can't really access very much with the universal life. So again, whole life wins on that one.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Before we jump into taxes, Christine, anything else?
Yeah, I just wanted to mention, I'm going to jump into taxes in just a second, but to your point, I feel like people are going to be like, well, what if it is the guaranteed funds that we're investing in there, or, we've got a level and we don't have cash built up in there. That is when the UL works well, right? So if you're using it for an estate planning and you don't have a ton of cash in there, you're doing it for a completely different strategy. You're doing it for estate planning, and we do use it for estate planning from time to time, absolutely. But we're specifically comparing this to an infinite banking policy, and infinite banking policies need cash. We need to maximize cash. And if we're trying to maximize cash in a universal life policy, we have to put it in the stock market. That is how we maximize the cash in there. So that's why we have to compare to the stock market when we're talking about it, right? We're looking for the cash values. So on to the next one, taxes. So this one is where it can compare. This is why we love life insurance, right? It is tax-free. And that's why people like using it, as well from a tax advantage side of things. The growth is still going to be tax-free, so it's fine there. The death benefit is still going to be tax-free, so we're good there. The only thing that is a downside is what you were just referring to, where we can only access 50% of the cash values. Well, we take these loans tax-free when we're, taking our funds back in our infinite banking policy and using them. If we can only borrow 50% and we need to take more than 50%, we're now making a withdrawal, which can become taxable. So that's where you can run into some issues there. On the tax side is if we need to take withdrawals, you're also messing with your compounding at that point as well if you need to take more than 50%. So we don't want to be doing that. It is tax efficient though, from the growth side, the death benefit and all that jazz. Again, why we use it in other places. But from the infinite banking side of things, not great if we need more than 50%. And the plan is to use as much as we need to use for our other investments, right? We want that 90% to be able to do it.
Yeah, but just one more comment on the taxes. So, like, how much tax do you pay on capital gains? In other words, you invest in the stock market, you buy a fund for $100 and it goes to $200. Well, that's a capital gain, right? So you're going to pay tax on half of that. So let's just do some quick math and say, great, I made $100. 50% gets included in my taxes, so $50. I'm in a 50% tax bracket, so $25. So I pay tax on $25 of the $100 gain, or I pay taxes of $25 on the $100 gain. Versus if I was in an interest-bearing stuff, I'd pay tax on the full 100, so I'd pay $50 in tax. So the stock market is already tax advantaged in that sense. So we're going to take a tax advantaged product and then throw it inside a universal life, which is a tax-free product to save a little bit more tax. Like, I would much rather my guaranteed, my savings, my bonds, my GICs inside a tax-free environment where I'm saving the full amount of the tax, as opposed to really I'm only saving on half of the tax because of the 50% capital gains inclusion.
Well, and you make a good point, Darren. When these first came out, there was no such thing as a tax-free savings account, right? They didn't have one in the 80s. They didn't have one. Now we have one. So would you use your tax-free savings account first? I 100% would use my tax-free savings account first if I wanted to invest in the stock market, because it's going to be more tax efficient. This was the better route back then, maybe, but now why wouldn't you use the tax-free savings account for something like that, right?
And then, Christine, like, we can talk about taxes, fees, volatility, all those other things, but at the end of the day, like, I've seen I've seen thousands. I've literally thousands and thousands of universal life products through my career, and we can't leave it without talking about human nature. So let's talk about human nature and how that comes into play, really, especially on the universal life.
Yeah, so with the universal life policy, there's a lot of flexibility. That's another reason they designed it the way that they did, so that you could lower your death benefit if you wanted to pay less. You can add extra cash in any given year. Nothing is needed. Like, there's not much needed in there to keep it going. There's tons of flexibility. The problem with that is that when you leave someone when it's not a systematic saving and you leave someone to not pay themselves first, they typically do not pay themselves first. That is human nature. They leave it to the last. And when you leave that to the last thing to be paid, I will tell you that there's nothing left. I've done numerous cash flow plans in my day. I'm a certified cash flow specialist, and I can tell you, if you do not put the money in first, it's not going to be there later. And that's what tends to happen with these universal life policies. It's not necessary. They don't need it, so they don't do it. And then they end up with no cash value at the end of the day, right? And I'm sure you've seen that lots, Darren.
We do reviews all the time, and a new client will come, and they'll come with their policies, and we're doing a review, and it's like, oh, well, what's this universal life policy you have from like 10 years ago? Oh, yeah, I was going to build a bunch of cash value, and I was going to be able to access it, and it was going to be, and I'm like, okay, well, it's showing a cash value of $0 or $50 or a couple $100. Oh, yeah, I don't think I overfunded it. I don't know. I was supposed to put more money in, but they never do, and it just doesn't get done. Okay, and then these products again can get confused because some people try to put you all in the same category as a whole life. Let's talk about really the confusion and how to not be confused as a consumer.
Yeah, so I think the confusion comes from how they are sold at the end of the day. So the first one that I want to talk about is kind of what you said about what happened in the 80s when people were illustrating a 12, 14, 15% rate of return inside of these. When an advisor illustrates a universal life, they pick a set rate of return. So now these days, I will give them credit. Typically, we are seeing people use a 5%, 6% rate of return, which is more in line with the market. But we don't get a 5 and 6% return every single year, right? We get actual rates of return every year. You're not going to get that solid 6% every single year. So when an advisor is showing an illustration that says, this is what it looks like with a 6% rate of return, this is what you're going to have for cash values, it's not possible. Like, it's not possible that your fund is going to do 6% every year. I'm sorry. The market fluctuations are going to change that. And those numbers are not going to add up to what they're saying they're going to add up to on the, on that projection that they're giving you. But if you show a guaranteed 5% every single year, it's going to look a lot like the cash values in a whole life policy, right? Because we are actually getting those inside of the whole life policy every year, and we're not losing them. We're keeping them, right? We can't go backwards. These go backwards in that any given year, and it's going to throw those numbers off. So a projection or an illustration shown by an advisor using a guaranteed 5-6% is going to look very similar to a whole life policy. So I can understand where the confusion would come from there, right? Very, it's confusing.
The illustration, but the underlying of the product and the end result's going to be night and day. But I like the average versus actual. I mean, I got a whole section in the book on Be the Bank on average versus actual, and it's like, oh, I'll just project it at 6%, but no, what's your actual return with that volatility included? It's a lot different. And then Christina, I want to dig into this YRT versus level. And level cost of insurance just basically says, okay, great, it's going to be, X amount, same amount every year for the rest of your life. And then insurance companies got a little creative, and advisors got a little creative, and they said, well, is there any way we can make it look better? And they came up with, well, we can in the early years, but then it's going to blow up in the later years. So I'm not a fan of YRT. The older YRT, there's a couple new products, specialty products now, but typically all the older YRTs. So if you think of it, so let's just say the insurance cost was 10 grand a year for a universal life, 10 grand a year for the rest of your life. And then your advisor comes in and goes, oh, we're going to do YRT, which stands for yearly renewable term. So yearly renewable term is kind of like it sounds, right? Every year it goes up. So what's the risk of a 30-year-old, let's say you started at 30, what's the risk of a 30-year-old dying in 1 year? Not that great. So how much is the insurance company going to charge for that risk of insuring them for a couple $100,000? Not a lot of money. What's the likelihood of a 93-year-old dying in the next year?
Very high.
It's pretty good.
Very high. Yeah.
I hope you don't die if you're 93 and listening.
Sorry.
But
Yeah.
it's a pretty good chance that from an insurance company, from a risk perspective, do you really want to insure that 93-year-old for 1 year and roll the dice as an insurance company? So what YRT says, okay, well, if level's $10,000 of premium, we're going to go yearly renewable term. So good news, when you're 30, it's only going to be, say, $500 for the cost of the insurance. So the other $9,500, we're going to put in the stock market, and we're going to get these great returns. And that's going to be great in the early years. You have this false sense of, wow, I've got 100, 200 grand in my cash value. But at some point, that YRT is going to cross over, maybe in your 40s or 50s, to, well, it's no longer $500 a year of the insurance cost. Now it's more than $10,000. So then they get in the later years where there's 11, 12, 15, 18, 20,000. And the illustration is illustrated, oh, but we have built up a bunch of cash in the early years. We'll just take that cash out in the later years. Well, I've been in this business for 30 years, and of the 1,000 plus universal life products I've seen, 0% have worked out as projected or as good as projected. 0.0%. Those things never work out like they should. And unfortunately, we've been on the receiving ends of having to explain to clients going, well, I know you thought your universal life was paid up because your advisor said you only had to pay for 20 years, but that was assuming we get an 8% return on the market every year, plus the 4% fee, so really a 12% return every year without missing a thing. So in fact, you're 72 years old now, and now you have to start paying $20,000 a year if you want to keep this policy in force. If not, it's going to lapse and all your money's gone. Like, those are literally the conversations we've had to have, not the ones we sell, but those are older policies, how horrible they are. So if you see a YRT on your policy, talk to an advisor who's an expert at this and see if you can get that switch to level, or if there's some options, or you might, run the math to see if it makes sense. When is this going to blow up, and does it make sense to take the cash that you can now? So YRT, no good. Level, okay. But either way, it's still universal life, and it doesn't fit for infinite banking or building up cash value that you want access to.
Yeah. And again, if you looked at that projection, you had all that extra cash in the early years, it's going to look like it's doing much better, right? It's going to look like it's doing much better in that YRT, which just isn't the case long term, because you're not seeing the aftermath of that yearly renewable term coming up. So again, very careful when you're looking at these illustrations, deciding on your products, what you're going to use. And the infinite banking product, we know that you've got to use the participating whole life. But I want to make the comment that these can be set up incorrectly too. So unfortunately, there's a lot of people, there's only a handful of us that actually specialize in infinite banking across Canada, that know how to set it up and do set it up correctly. There's a lot that don't. And there is a certain way that you need to set it up. And if it's not set up correctly and it's still a participating whole life policy, it's not going to do what you want it to do either. It's not going to maximize your cash values. So it's super important that you're working with somebody that specializes infinite banking when you go set that up, so that you're maximizing your cash values. You want, you want it to be as cash value efficient as possible. And it's not necessarily going to be that way if you're not working with a specialist. So there's something that I want to just kind of run by there as well, that again, just like the UL can be put together wrong, the same thing, the structure for a whole life policy can be structured wrong as well for the infinite banking. So you got to be careful there.
Cool. Very, very, very well done, Christina. I like your explanation. So now you've listened to this whole podcast, and maybe if you're still confused, I'm going to close here with a really simple explanation. And if you could have fast forward and listened to the very end if this is your style of learning. Okay. So I'm going to close with this. When it comes to infinite banking, participating whole life with a practitioner who knows what they're doing, good. Universal life, bad. And it's as simple as that. Listen to the whole podcast if you want to know the details, but universal life just can't work for infinite banking in Canada. Sorry, doesn't work. That's it. Thanks for watching. Thanks for listening. Have a wonderful day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.